Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Hello, everyone, and welcome. Today, we're going to deconstruct one of Canada's most powerful and, frankly, most misunderstood tax provisions, the Principal Residence Exemption. You see, for most Canadians, selling their home is the single largest financial transaction of their lives, and getting this exemption right, well, that can literally save you tens, if not hundreds, of thousands of dollars in taxes. And this really isn't an overstatement. There's a huge disconnect between what the tax law allows and what people actually claim, and it's all down to a lack of knowledge. So our entire goal here today is to bridge that gap. We're going to translate the complex tax code into a clear, actionable strategy that you can use. So here's our game plan. We'll start by tackling a very costly misconception. Then we'll get into the nitty-gritty of what a principal residence actually is. We'll walk through a real calculation, cover the paperwork, talk about some common traps to avoid, and wrap it all up by showing you how to use this as a serious tool for tax planning. Let's dive in. Okay, first things first, let's really get to the core of what this exemption is for and why so many people get it wrong right from the start. On the surface, it seems pretty simple, right? The Principal Residence Exemption, or PRE, means you can sell your home and not pay tax on the profit. But that simple definition hides a ton of complexity. The real power and the real savings are buried in the details of how this thing actually works. So, let's ask the most important question. What is a principal residence in the eyes of the Canada Revenue Agency? Getting this definition right is absolutely critical, because this is where the biggest, most expensive mistakes are made. And this right here is the heart of the matter. We all think in terms of our main home, but for tax purposes, that phrase doesn't really exist. The CRA uses a very specific legal term, ordinarily inhabited. And that wording, well, that changes everything. It offers a level of flexibility that most homeowners have no idea about. So for a property to even be in the running, it has to meet these three conditions. First, it has to be a housing unit. Second, it must be what we call capital property, meaning you hold it for personal use or investment, not as business inventory you're trying to flip. And third, there's that magic phrase again, it must be ordinarily inhabited. Let's break that down. Now this is the real eye-opener. Ordinarily inhabited does not mean you have to live there 365 days a year, not even close. In fact, even short stays during the year can be enough for a property to qualify. Think about what that means. Your family cottage, a ski chalet, maybe even a condo in another country. Any of these could potentially be your principal residence for tax purposes. But here's the crucial limitation. While you might have several properties that could qualify, your family can only designate one of them as your principal residence for any single year. And that's what shifts this from being just a rule to being a strategic decision you have to make annually. All right, enough with the theory. Let's roll up our sleeves and crunch some numbers. We're going to walk through the CRA's actual formula with a concrete example to see exactly how this designation strategy plays out in the real world. So let's picture this. You sell a house and you've made a cool $1 million profit on it. That's a massive capital gain, which would normally come with an equally massive tax bill. And let's say you've owned this particular property for a long time, a total of 38 years, from 1987 all the way through to 2025. Now, during that 38-year period, you designated this house as your principal residence for 35 of those years. For the other 3, maybe you designated the family cottage instead, because it had a bigger gain in those years. So how much tax do you actually owe on that $1 million? Well, the CRA gives us this formula. You take the number of years you designated the property, in our case 35, and you add 1. Then you divide that total by the number of years you owned it. That little +1 is a bonus rule, by the way. It helps cover you in years where you sell one home and buy another. So for us, that's 36 divided by 38. This means a whopping 94.7% of your profit is completely exempt from tax. And here's the bottom line. Of your $1 million profit, only about $53,000 is actually subject to capital gains tax. The other $947,000? It's yours to keep, completely tax-free. That is the incredible power of using the Principal Residence Exemption strategically. Okay, so understanding the math is one thing, but you also have to report it correctly. The CRA has very strict, non-negotiable rules for how you claim this exemption. When you sell, you have to formally report that sale and make your designation on your tax return for that year. You'll be using two key documents, Schedule 3, which is for all capital gains and losses, and Form T-2091, which is the specific form for designating a principal residence. And let me be perfectly clear about this is not optional. Even if your entire gain is sheltered by the exemption and you owe zero tax, you still must report the sale and file these forms. If you don't, the CRA can come back at you with very significant penalties, and they could even disallow your exemption claim entirely. Now, let's turn to a very serious pitfall. This is a situation where the CRA might look at your sale and decide your property is completely ineligible for the exemption, period. The CRA is always on the lookout for patterns that suggest you're not just a homeowner, but you're actually in the business of flipping houses. If they see a history of quick renovations and resales, or you're a real estate professional, they can argue your home wasn't capital property for personal use. It was inventory for a business. And if that happens, the exemption is gone. 100% of your profit becomes taxable as business income. This is a perfect visual of what triggers a CRA red flag. Seeing multiple property sales within just a few years starts to look like a pattern of speculation. It doesn't look like someone is just moving house. Now, every situation is unique, but a sales history like this almost guarantees a closer look from the CRA. So, let's bring this all together. I want you to stop thinking of the PRE as just a tax rule you deal with when you sell. I want you to start seeing it as a dynamic and powerful tool you can use for long-term strategic financial planning. This is the ultimate question. If you own more than one property that could qualify, a home and a cottage, for example, you need to be asking this question every single year. Which property do I expect to appreciate the most? By strategically designating the one with the highest anticipated gain each year, you can actively maximize your tax savings over the long run. It's that proactive, forward-looking planning that truly unlocks the full financial power of the Principal Residence Exemption.